Once again, everything can be a good idea if it's cheap enough, and everything can be a bad idea if it's too expensive. This is true whenever you want to buy anything. It's also true for other strategies. For example, in the last lecture, we discussed a way to speculate on volatility. But whether that strategy is profitable or not depends upon the prices of the options. As it turns out, it depends critically on whether the market prices reflect a better estimate of volatility than your estimate of volatility. We also saw that you might want to hedge using options. One of the critical parts of the hedging strategy is the option delta, the amount the price of the option changes given a change in the value of the underlying. Again, price is important. In this lecture, we're going to examine two ways to price options. The first way is called the binomial method. The second way is the famous Black-Scholes method. Now, why two methods? Okay, so there are two reasons. One reason is purely pedagogical. It's much easier for you to understand the Black-Scholes formula if you understand the binomial first. The second reason is that the binomial is actually more flexible than the Black-Scholes formula in many situations. These situations are complex and sort of beyond the scope of this course. However, once you see how the binomial works in this course, in this lecture, you'll be able to do some reading on your own to understand these other more complex cases. By the way, I recommend any of the books by John Hull. John Hull has a series of books. They all have derivatives in the title. They're all basically very similar in terms of what they cover. Some are harder than others, but I highly recommend them. He also has a website that you can go to, so just Google John Hull's website, and he has a lot of lecture notes on options on his own personal website. Now, before getting to the formulas, let's just get a sense of when an option will be expensive or cheap, or how the price of an option might change given a change in market conditions. Let's compare two calls that are identical, except that one has a higher strike price than the other. The one with a higher strike price is less valuable. It's less likely to end up in the money. And if it does, the one with the lower strike will be more in the money than the one with the higher strike. Let's compare two puts and calls that are identical except that they expire at different times. So in this case, we're going to consider both puts and calls. The one with the longer time to expiration will be worth more than the one with the shorter time to expiration. And this is true again for both puts and calls. The one that is alive longer has a greater chance of meandering around until it ends up in the money. Finally, let's compare the value of a put or a call when volatility is low. When the volatility is low versus the volatility being very high. As with the time to expiration, the greater the volatility, the more likely it is that the underlying will end up at some extreme point, which half the time puts it in the money, which makes it more valuable. Thus, greater volatility means a higher value for the option. This is true for both puts and calls. An increase in volatility increases the chances of both big drops, which improves the value of the put, but also big increases, which improves the value of the call. Now, by the way, a natural question is to ask is how much bigger should the price of the option be given, say, an increase in volatility? Also, what's an appropriate price period? Say you want to buy protection from some downside risk by buying a put. Recall the protective put strategy? What is a fair price to pay for that protection? This is exactly the same question that you'd ask when buying car insurance. Why not ask it with respect to options as well? So, how do you price an option? The pricing techniques we'll discuss here price options relative to other securities in the market. The key insight of these pricing models is that you can build structures out of existing securities that behave just like options. If that's true, then it must be the case that the option value is exactly the same as the cost of the so-called replicating strategy. If the values of the options and its replicating strategy are not the same, then there's an arbitrage opportunity. Now, recall that an arbitrage opportunity is when two things that are the same have a different price or different values in the market. To exploit an arbitrage opportunity, what do? You buy the cheap one and you sell the expensive one. And by doing that, you make the two prices come together. This is just like if I had in my garage a bunch of spare parts. And let's say I was trying to build a 5 Series BMW in my garage. What I would do then in this case, right, is I would make a homemade BMW and then I would see what that exactly cost. If that cost a different amount than the actual price of the BMW, then there's an arbitrage opportunity. If I could build, say, for example, a 5 Series BMW for $40,000 in my garage, but BMW sold them for $60,000, then I would build them in my garage and sell them for $60,000. The opposite is also true. If BMW sold 5 Series BMWs for $30,000, then I would buy one, tear it apart, and sell it for the parts, which are worth $40,000. So again, this arbitrage notion is that the price has to be just right. It can't be too high or too low. Either way, there's an arbitrage strategy that exploits it. Now for options, not BMWs, I will show you how to form a portfolio of the underlying asset and risk-free bonds that replicates the payoff on the option. Thus, the cost of the replicating portfolio must equal the price of the option. Or put differently, the price of the option has to be exactly equal to the price of that replicating portfolio. You must be thinking, I got to see this. How on earth can he replicate the payoff on an option with just an underlying asset and bonds? I'm going to show you this using the binomial model. With the binomial, I need what is going to appear to be kind of a really weird, tenuous assumption. But I'm going to argue that although it seems crazy, it's really not all that bad. And it's a very powerful assumption because it lets us price the options in many situations. So after the binomial, we'll go through the Black-Scholes formula. Okay, so what's the big assumption? The big assumption in the binomial is that at any point in time, over the next interval in time, the price of the underlying can only take on two values. This is why it's called the binomial model. Bi, meaning two, refers to the number of possible outcomes after a period of time has elapsed. Given only two possible outcomes, we can match the payoffs on the option exactly. That's because we have two levers, the underlying and the risk-free bond, that we can pull to match the two possible outcomes on the option. But aren't there many more than just two possible outcomes for the underlying value, especially for options that are very volatile and expire many periods in the future? Well, of course there are. So isn't this method very limited? All right, so the answer is no, because we're going to embed this simple model in a multi-period model that will make essentially this kind of seemingly ridiculous assumption of only two values actually kind of go away. I'll show you this in a second. Let's see exactly how this is going to work. At any point in time, the price will change over the next period by only one of two factors. One for the price goes up, and the other for the price goes down. Let the up factor be 1 plus U. So U is the percentage return in the underlying when it goes up. Let the down factor be 1 minus D. So D is the percent return when the underlying goes down. Now, by the way, where do you get these U's and D's? In a second, we're going to go through an example in which I give you the U's and D's, but this is how the method you would use to essentially figure out what the U's and D's are to use if you want to do this for yourself. You essentially have to calibrate U and D to the amount of volatility for the underlying security. Okay, so now how do you get the volatility of the underlying security? Well, you could use a single factor model. Remember that the single factor model is a model that relates the return on an individual security to the return on the market and also idiosyncratic returns. But realize that the regression results that you get give you volatility from the past. If you're trying to price an option going forward, you want to know what the volatility is into the future. So how would you get that? Well, you can actually get an estimate of market volatility by looking at something called the VIX, the VIX. The VIX is actually a derivative contract that you can trade that's based upon the level of volatility as implied from the prices of options written on the S&P 500 future index. So let's hold on to this for a second, right? What does this say? We have the VIX is actually an implied volatility that we figure out from the prices of S&P 500 futures options. We look at the option prices, and then we say, what must the market be thinking is the volatility for the S&P 500? The VIX is essentially the level of that index. It tells you something about the market's view of what they think going forward will be the volatility in the S&P 500 over the next year. It's an annualized index, so it's annual volatility. So the level of the VIX is actually the standard deviation of the return on the S&P 500 as implied from these option prices. Now, by the way, at the peak of the financial crisis in 2008, the VIX was close to 80%. So a more typical value for the VIX is closer to like 15 to 20%, somewhere around 17%. So 80%, that was unheard of. That was one of the highest values the VIX had ever achieved. Okay, so now once you have these volatilities, you can actually pick the U and D. Once you have the volatility of the market from, say, the VIX index, then you can use the single factor model to figure out what the variance of the underlying security is by taking the beta of that security, squaring it, multiplying it by the VIX index. The VIX is a standard deviation, so you're going to have to square that. And then you can take probably the in-sample estimate of the variance of the idiosyncratic term and add that on. That will give you an estimate of what the volatility of the underlying security is that you're trying to price the option on. Now, as soon as you get that underlying volatility, let's call that sigma. What you want to do is you want to calculate U as EXP raised to the sigma times delta T. Take all of that minus 1. Okay, so what's delta T? Delta T is the length of the interval. So if you're talking about monthly ups and downs, delta T would be 1/12. If you're talking about an annual up and down, delta T would be 1. So we're counting time in years. The delta T stands for what's the change in the amount of time over an interval that you're considering. That gives you a sense of how long the volatility will go over. And so you scale up the volatility up or down by the amount of time that's going to elapse over the interval. All right, so we have U is equal to EXP raised to the sigma times delta T minus 1. That gives you the up factor. The down factor, D, is equal to 1 minus EXP raised to the negative of sigma times delta T. Okay, so now once you got those, you now have the U and the D. That's how you would get those. Now, given those U's and D's, let's figure out how we would go about pricing the option based upon the binomial formula. For example, let's consider U equals 0.1 or 10% and D equals 0.2, 20%. Now, by the way, I'm just going to use these numbers. I sort of arbitrarily picked them so that the values will work out. They actually don't come from a particular volatility estimate. Okay, now let's let the current price be 100. And let's say that over the next year, what's going to be the prices for the underlying security? You take 100 times 1 plus the up factor, 10%, so it can be either 110. Or in the down case, right, we're going to take 100, multiply that by 1 minus the down factor, 20%, going to be $80. So that's how you'd use the U and the D. Just for now, let's say that the likelihood of up, let's call that PU, and the likelihood of down, PD, is such that the person investing in the underlying will get a positive return. Else they wouldn't invest it in the first place. For example, if PU is 80% and PD is 20%, or 0.8 and 0.2, then the expected future value of the underlying is going to be what? 0.8 times 110, that's the price in the up state, plus 20% times the price in the down state of 80, that's $104. Thus, if you buy it at the current price of 100, the expected or average return over the year is going to be 4%. Sometimes it's useful to depict this in a tree diagram. With the tree diagram, what you do is you would start over into the left margin with the current price of 100. And then you draw a line up, upward sloping, that tells you where the price is going to go if the price goes up. And have that, land on 110. Then draw a branch down that falls down to what the price is going to be in the down state. Let's call that 80. Now, by the way, this 100, 110, 80, this is clearly not realistic. To make it more realistic, we might want to divide the interval of time in half. In that case, what would we get? Well, you take 1.1 for the 10% up, raised to the half power minus 1. That gives you 4.88%. Let that be the up factor. And then the down factor is essentially going to be something like, what, 0.8 to the 1/2 power minus 1. That's going to be not negative 20%, but negative 10.6%. Then what's going to happen if you do that, right, is you have the tree start at 100, it goes up or it goes down, and then if it goes up, from there it can either go up again or it can go down. Alternatively, if it goes down the tree branch, and from that point it can either go up or go down. So what ends up happening is you build a tree that has many more branches. Thus, the 2-period problem has a tree with 3 final endpoints. By the way, each of the points that has 2 branches growing out of it is called a node. The tree starts with a node at 100. After a period, it has 2 nodes, one at 104 and one at 89.44. Then there are 3 final nodes. If the option lives on past this final period, the tree would continue to branch. Note that if we can solve a problem with only 1 interval and 2 outcomes, then we can solve a 2-period 3-outcome problem. The 2-period 3-outcome problem is just a bunch of separate 1-period 2-outcome problems. And if we can solve the 2-period 3-outcome case, then we can do many, many, many outcomes by the end of the year. This is simply a tree with a bunch of branching nodes after every short interval of time. The tree, by the way, is often called a lattice. With such a tree, there are many outcomes possible at the end of the year. In general, there is a probability distribution associated with the endpoints. The likelihood of the extreme values is less than in the middle. That is, there's only one way to get to the very top on the final spot, right? The underlying has to go up and up and up every period. If the probability of going up is 0.8 in this case, say for each day, then the likelihood of it being at the top is going to be 0.8, 252, which is equal to, what, 3.8 to e to the negative 25th. That's 24 zeros after the decimal point before we get to the 3. So e to the negative 25th, scientific notation. All right. Now, why did I raise it to the 252nd power? That's the number of trading days there are in a year. Similarly, the probability of the bottom node is going to be 20% down, raised to the 252nd power. That's 7.23 times e to the negative 177. This is a much smaller probability than the probability of the top node because the probability of up is greater than the probability of down. Now, there are many more ways to get sort of to the middle, right? You could have 126 up and 126 down. You could have 1 up, 1 down, 1 up, 1 down. Do this over and over again 126 times. So the probability in the middle bunch of possibilities is higher than on the ends. Note that the peak of the distribution on the end need not be in the middle of the lattice. This is again because the probability of up and down are not the same. If we let the number of periods grow by shrinking the interval between time periods, then the probability of each possible outcome actually becomes a normal distribution. Okay, so the point here is that even though we start off with sort of a hokey assumption about it can only go up and it can only go down, we can actually use this over and over and over and over again to get solutions to the price of an option when there's many, many possible values at the end. We do this by essentially embedding this 1-period 2-outcome problem into this much larger problem where we're solving that problem over and over and over and over again. Okay, so now that we see that what we need to do is solve a 1-period 2-outcome case, let's see how to do that. Let's consider a specific example. Let's consider a call option. Let the exercise price be 55. Let the risk-free rate be 2% over the period before expiration. So this is going to be a periodic rate, not an annualized rate. 1 period, let's call it a month before expiration. Let's say the stock price is 55. At expiration, say in a month, the stock price might either rise 33.33% to 73.33 or fall 25% to 41.25. So the up factor is 0.33 and the down factor is 0.25. Recall that the exercise price in the option, let's say it's 55. Thus, at expiration, the option is going to be worth what? Well, if the price goes up to $73.33 with a strike price of 55, it's going to be worth $18.33 if the price goes up. But if the price goes down to $41.25, it's out of the money, it's worth nothing. Okay, now what we need to do is form the replicating portfolio. Let's let X denote the number of shares of the underlying stock we buy, and let B denote the amount of the risk-free bond we buy. By the way, if B is a negative number, that means we're borrowing. So negative means you're short. Okay, so what we're going to need to do here is we're going to need to pick X and B to solve two equations simultaneously. The first equation is X times 73.33 plus B times 1.02 has to equal $18.33. So in other words, if we have X shares of the stock and the price turns out to be $73.33, and we have B units of the bond, that B units of the bond is going to grow, what, in 2% from $1 to 1.02, that portfolio will be worth $18.33, but only in the event that the stock price goes up to $73.33. The second equation that we need to solve is X times $41.25 plus B times 1.02. That has to equal 0. That means we're replicating the payoff on the option when the stock price falls. A little algebra shows that the solution to this is X is equal to 0.57144 and B is equal to negative 23.11. That is, you should buy 0.57144 shares of the stock, or so that's about 57% of the shares of the stock, and borrow $23.11 at the risk-free rate. Recall that the option delta is defined as what? The change in the option price divided by the change in the stock price. In this case, the delta is equal to what? It's equal to $18.33, because that's the change in the option value at expiration, right? It's either worth $18.33 or it's worth 0. Let's divide that by what is the change that's possible in the stock price. The stock price is either going to be $73.33 or it's going to be $41.25. So in this case, when I take $18.33 and divide by the difference between $73.33 and $41.25, what do I get? I get 0.57144. Okay, so that's what the delta is. The delta is the amount that you need to put in the underlying. If we only buy 0.57144 of the stock, then what's going to happen to our values if the price goes up or goes down? So if we only take a stock position, what are we going to get? Right? If the price goes up to $73.33, then that 57% of a share is going to be worth $41.90. But if the price goes down to $41.25, then that 57% of a share is going to be worth $23.57. Okay, so note that this difference between the $23.57 and the $41.90 is what? It's $18.33, which is exactly the difference in the payoff on the option. But we haven't really replicated the payoff on the option yet because the option goes from 0 to $18.33. What we have here is something that starts off at a different level and moves up $18.33. So what we need to do is borrow an amount B so that we owe exactly, in this case, $23.57. That way, we have $23.57 worth of the stock if the stock price goes down, and then we owe $23.57. When the stock price goes down, we end up having a value of our portfolio, the replicating portfolio, is equal to 0, which is exactly the value of the option in the event the stock price does drop. That is, what we need to borrow one period before is the $23.57 discounted back one period at the 2%, the interest rate. That's $23.11. Note that this B also works if the price of the underlying rises. If the stock price rises to $73.33, then our stock position is worth what? It's 57% of a share times $73.33, that's equal to $41.90. And if we owe $23.57 at that point, then our net is going to be exactly equal to $18.33. And this is the payoff on the option when the stock price goes up. So what just happened? We replicated the payoff on the option just using the underlying and the T-bills. We just built a BMW out of parts in my garage. If the replicating portfolio and the option generate the same payoffs, then it must be the case that they have exactly the same price. In this case, what's the cost of the replicating portfolio? Well, we went out and we bought 57.144% of a share. The current price of the share was $55. And we borrowed a B of 23.11, so that was a negative number for B, $23.11. So we take 57% of 55 and then subtract off $23.11. What do we get? We get $8.32. This is the price of the option. This is what the option price should be, according to a no arbitrage strategy, or a strategy in which the replicating portfolio and the value of the option, which generate the same payoffs, have exactly the same value. All right, there is an alternative way that's equivalent, and this is called risk-neutral valuation. The Black-Scholes formula is also based upon risk-neutral valuation. The risk-neutral valuation argument is as follows. Risk and risk aversion had nothing to do with the pricing of the option, and that's because there was really no risk in the option. We could replicate its payoff exactly. Thus, the option is considered a redundant security. So if that's true, then we're going to price it according to a lack of arbitrage. That is, the price of the option must be the same as the cost of the replicating portfolio. If there is any risk in the economy, it's going to be in the price of the underlying. If we can find probabilities that explain the prices of the securities used to replicate the option, then we can just use those probabilities to price the option. And by the way, those probabilities don't have to be actual probabilities. They can be sort of pseudo probabilities that explain the price of the underlying under risk neutrality. All the probabilities have to do is be consistently able to price both the underlying security and the risk-free bond. Once we can figure out what those prices are based upon in terms of probabilities, we can use that probability to price the redundant security, the option. Risk-neutral valuation prices the option as the expected value of the final payoffs using these risk-neutral probabilities. Okay, so let's see if this works. Once we work through the example, you'll see how exactly it works. It can be a little bit mind-blowing at first, but we'll get through it. All right, so step one. We're going to go through this, by the way, in a couple of steps. Pretend that investors are risk neutral. Okay, so this is the fictional part of this story. Calculate the probabilities of up and down, PU and PD, that would make a risk-neutral investor indifferent between holding the stock and investing in the risk-free bond. So we have PU and PD. PD is going to be 1 minus PU. It must be the case that PU times 1 plus the up factor plus 1 minus PU, all of that multiplied by 1 plus the down factor, has to equal 1 plus the risk-free rate. So that's PU times 1.333 plus 1 minus PU times what? 1 plus D, that's 0.75, has to equal 1.02. If we hit this with a stick for a little bit, what we see is PU equals 46%, or 0.46. Okay, what's the next step? Step 3 is using the risk-neutral probabilities, calculate the expected payoff on the option. So what are the two possible values the option could be at expiration? Either 1833 or 0. Take the probability of up multiplied by the value in the up state. Take the probability of down multiplied by the value in the down state. So take the 46%, multiply that by 1833, then take 1 minus the 46%, multiply that by 0. What do we get? We get $8.48. All right, step 4. Because that's in the future, we need to discount it back to the current period. So take $8.48, discount it back one period at 2%. That's $8.32. And this is exactly the price that we got using the replicating portfolio approach. So risk-neutral valuation essentially works in this case. Okay, we've just shown that the price of an option is the expected value of its payoffs using risk-neutral probabilities that are inferred from the prices of the underlying securities. The prices as a result rely on options being redundant. What we're going to do is we're going to do the same thing for the Black-Scholes. So let's see what the Black-Scholes looks like. Okay, so the Black-Scholes, by the way, was completely revolutionary. It was very influential because it essentially gave a theoretical justification for techniques that were used prior to that. And with the development of the Black-Scholes, essentially what this did was this gave everyone sort of permission to use it, and it just sort of pervaded much of modern finance thereafter. Let's go through the formula for Black-Scholes. This is what the formula looks like. It says the price of a call is equal to the current stock price times something that we'll say is N of D1. In a second, I'll tell you what D1 is, and I'll also tell you what N of D1 is. So we take the current stock price multiplied by N of D1 minus the strike price times EXP raised to the negative RT. That's essentially just the present value of the strike price. All of that's going to be multiplied by N of D2. All right, so we have a D1 and we have a D2 floating around. D1 is the ratio of the following two things. We've got the log of the ratio of the current stock price to the strike price plus the quantity, the risk-free rate, plus half of the variance of the underlying security, all of that multiplied by the time to maturity. Take that and divide by the standard deviation times the square root of the time to maturity. D2 is just going to be D1 minus the standard deviation of the underlying times the square root of T. Okay, so what we need here is we need N of D1 and N of D2. N of D1 is the probability that a normally distributed variable with a mean of 0 and a standard deviation of 1 is less than X. So, I'm sorry, D1. To calculate it, you would use your Excel spreadsheet. Specifically, you can use the function normsdist, and then you put the number that you want to use for D1 in there. That will spit out N of D1. So by the way, you can think of this formula as telling you the following. The call price is equal to the present value of the expected payoff conditional on the call being in the money minus the present value of the strike price. So the Black-Scholes formula is essentially just what is the expected payoff on the call using this risk-neutral valuation technique. In this session, we've examined the two most used models to price options. Both are based upon risk-neutral pricing, which is based on being able to perfectly replicate the option payoffs using the underlying in risk-free bonds. More recent developments have noted that in some cases you cannot fully replicate those payoffs. As a result, people may actually pay a premium over those risk-neutral valuation prices in order to achieve the sure downside protection that you can get from a put. But the Black-Scholes and the binomial methods serve as a good benchmark. Furthermore, both are used extensively. Thus, it's important for you to know what they are and what they're based upon. And by the way, there are numerous online calculators that will allow you to plug in all the different parameters and get a price based upon the Black-Scholes value.